Have the past couple months got you thinking that you may need a little bit more room or an underground bunker to hide from your children when you're supposed to be homeschooling them? Or a hair salon? I guess you need an in-house stylist for that. Anyhow, sorry, I was daydreaming there. But what about your house goals? Do they involve leveling up, getting a larger home? Well, if so, on this episode of Behind the Scenes, we're going to be talking to one of our favorite lenders about that process of moving from this home to the next home and what that looks like from a financial and a mortgage standpoint. So enjoy.
Welcome to another episode of Behind the Scenes.
Dietrich, thanks for joining us today on our Behind the Scenes. Appreciate it.
Absolutely.
So Dietrich Miklautsch has been with he's with Guild Mortgage, and man, we've been working together for over 13 years now, huh?
Yeah, it has. It's been a long time.
So you've been with Guild for a couple years, but how long have you been in the business?
18 years.
Wow. Okay.
Yep. And helped a little over 1,100 families over that time.
Well, that's fantastic. So, I mean, over the course of us working together, we've worked with lots of different clients across the whole array. But today, I wanted to chat with you about those move-up buyers. So, folks that are not first-time buyers, they're already in a home and they are looking to get into a bigger home or a different home.
Absolutely.
So I thought we'd key in on those and the special circumstances around those clients.
Yeah, no, absolutely. There's a few different things that we like to do in regards to move up buyers. I think one of the big keys is to make sure that we do appropriate planning ahead, whether they're looking to buy within the next year or sooner. That definitely it's never too early to have a conversation on the financing side to prepare, just like they would prepare from a listing or selling side. The financing side is the more we have options, the more we can plan and help them with what's available in the market and how to put them in the safest and strongest position when it comes time to move up.
Okay, so Dietrich, as these move-up buyers are thinking about these plans, what would you say they should start thinking about and planning as they look ahead to a move-up type of situation?
Absolutely. Well, there's a few things that we always want to look at, and it comes down to cash flow and liquidity and having a plan for each of those pieces. In our market, as you know, in most areas, it can be very competitive. So we want to have maybe a plan A and a plan B based on what they might run into so they can be fully prepared, whether they need to sell first or maybe look at going into a property non-contingent without selling first, maybe for multiple reasons. One, to make their offer stronger, but two, because they don't want to move first and they want to make sure that they find the house and move into it and then set their house up for sale, with moving out and getting it staged. And that way they can have that flexibility and control. So in the financing piece of it, I'll review ways that we can achieve that through the loan packages that are available and from a budgetary standpoint, how we can prepare for that, whether it's utilizing some equity in the home, to allow them to purchase the new home, or it's just from cash from other avenues if we're trying to do something that's a non-contingent.
Okay, great. And maybe we can dig a little bit more into that. Question for you: we, as you know, we do property management as well, and there have been lots of clients that we've helped purchase a new home and then they hang on to their home as a rental. So what does that look like? I mean, when you have that conversation with them and you're looking at their finances and you're trying to decide whether that's an option or something that they would like to do, how do you approach it? Let's say if they decide to keep the home as a rental instead of selling.
So if they want to have the potential to keep the home as a rental, and we're in the initial planning stages and we're still a ways out, while they're still deciding how they want to handle it, they can, look at opening up a line of credit on their current home so that they have access to some of that equity. If they do potentially need to tap that for a down payment, then they can access that without having to use other cash positions, stocks, or other funds in order to put the down payment on the new home. And essentially using the current home as a bridge to get into the next home. And then we would look at how that loan is structured, make sure it's structured efficiently from a rental standpoint, look at the cash flow, and then that in turn helps set the stage for the new home to make sure that big picture fits their overall position and keeping into account how much of monthly that they'll be able to handle, and then what we should have on hand for reserves for both that existing property and the new properties. And so, and actually from a qualification standpoint, when moving out and retaining as a rental, there's ways to factor in payments to offset those mortgages. So there's definitely some ways to do it in a planned, phased approach and in a safe approach if proper planning is done.
So to that point, how far out, particularly if somebody's looking to go the rental route, how far out would they want to start that? Because I'm guessing if you are going to get a line of credit off the rental, you probably want to start that process early on. Like, how much lead time would you?
Yeah, I'd say the sooner the better, but at least 3 months prior to looking at doing anything. So anywhere from 3 months to a year, as far as the planning goes, to make sure that there's ample time to look at the big picture and evaluate what is best for their specific situation.
Okay, so Dietrich, say the client is not able to or has no interest in renting their home. So they're going to sell their home, buy the new home. Obviously, there's contingent versus non-contingent. If they have to be contingent and there's no way around that, then so be it. There's not really much from your standpoint that we can do on the financing side. But if they can go non-contingent, talk to us about some creative strategies for being able to go non-contingent.
Yeah, no, absolutely, Aaron. So there's usually two reasons that prevent somebody from going non-contingent. Usually it's a cash flow problem, whereas they don't have the ability to qualify for both property payments, or a liquidity issues where they don't have the funds, or it's just not in a place where they want to access it for tax purposes or so forth. So those are two of the most common things that I see. So options for both of those. One, if they've done their planning, they've had that home equity line of credit open on their home as a rainy day fund, then they can access that for a down payment. So that would allow them to use that equity for a down payment on the new house without having to sell to access that equity. And so they don't have to access that from another account, or if they don't have the funds in another spot as well. So that would handle the down payment piece of it. And then once they sell, they could re-amortize their loan and drop their payment if they have additional equity that they would clear from their sale in order to reduce their monthly payment obligation. That's a lot of questions that I get. Said, hey, Dietrich, we could qualify, but I'm uncomfortable with what that payment is because we still have a lot of equity remaining in the house that we want to put towards the new house. I say, that's no problem. We'll qualify you on the new payment, and then once you sell, we'll take that additional equity and we can apply it directly to that loan and re-amortize the loan without needing to refinance. If the market does allow a refinance to make sense, then we can do that, but it's not required. So that's definitely a great option, and I've seen a lot of people do that over the years. The The second part of that is qualification. So if somebody has the money, but they can't qualify using both mortgage payments, the new house and the existing house, then there are some special products that do allow the mortgage from their departing residence to be taken out of the ratio. So there are some creative ways to do that. There may be a premium in terms of that loan product and pricing, but if it allows them to get the house and allows the flexibility, it ends up not costing that much more than a normal loan. And then again, they get that loan, they can definitely restructure that loan at a later date as well. So those are a couple ways that we've seen clients successfully do non-contingent and have it work out very well.
Let me ask you about this. So we get questions about this, and bridge loans. These aren't really a thing anymore, are they? Or some people are offering them, but talk to us a little bit about that.
I mean, a bridge loan is it's essentially a loan to tap the equity in your current home. And there may be a few that are out there, but they're harder to qualify for. You still have to qualify for the bridge loan payment, the current house payment, and the new house payment. So it's even harder to qualify than what I mentioned with the line of credit that I talked about before. That's the easiest way to do it and the most cost effective. That's another piece. The bridge loans can be thousands of dollars in cost and higher rates, and the line of credit is usually no fee or little fee to get set up and a reasonable interest expense, and it's only when you take out the money. So there's bridge loans. While the term might be well known, there's different ways to bridge, so to speak, the gap in the scenario. It doesn't always have to be a quote unquote bridge loan. It could be a bridge strategy, so to speak.
Got it. Okay, perfect. So Dietrich, we want these move up buyers to be as prepared as they can. We hear terms floated out there: pre-approval, pre-qualification, underwritten. Can you just walk us through maybe what that actually means and how these move up buyers can put their best foot forward and be the most competitive and prepared?
Yeah, absolutely, Aaron. So there's three pieces that we commonly see from a financing standpoint, and some have different layers of validation and strength when it comes to someone accepting their offer. So the pre-qualification is just a snapshot of a verbal snapshot of their basic loan application information over the phone, and something like that. If the lender issues that without any documentation that they verify, that really holds no weight, as you know, from an offer standpoint, because until that documentation is verified, a pre-qualification, somebody could say whatever they wanted on the phone as far as what their financials are, but when they get the information and what they can document, it could be totally different. So we see that as being a dangerous situation to be in, and definitely one to avoid. The minimum that's out there is the pre-approval stage. So that would be an application, either verbal or online with a lender, and then a documentation list with a major income and asset credit documents that the lender or institution needs in order to validate and verify the application information and what can be calculated and used to qualify for a loan. So at a minimum, that would be definitely recommended as far as what's needed to make an offer. And that's probably, as you see, 9 out of 10 offers may have the pre-approval. 1 out of 10 offers has the full underwritten approval letter. And that's the highest and best way to go when you're financing versus cash. So the underwritten approval letter is everything that's done with the pre-approval, except the lender takes that loan package and application and actually submits it to processing and the underwriting team. They will then do their full checklist, just as like they had a property under contract, and will underwrite and approve their loan based on those documents and their credit profile. So when you have that underwritten approval and they can fulfill those conditions on that approval, the loan is ready to go. And basically have to attach the property, qualify the property, and then finalize things. So that, as you know, what you see is by far the strongest way, and it gives the most leverage in our market. With a listing, I've seen is, when you go up the listing agents, if you have an underwritten approval, right, you're gonna beat out a pre-approval if the offers are even, right?
Mm-hmm. So, and also helps with closing time too, right? Because once you've got it's fully underwritten, what are you saving there?
Yeah, I mean, you can, and we're, in a normal transaction, with just a pre-approval status, we can still close in 25, 30 days. If you have an underwritten approval letter, it can be done in 15 to 25 days. So it really can compress the timeline. And, you're up against a cash offer that can close in 15, 20 days, then you'll be right in there with them if the price is there. So it really helps put that financing package to the top of the list, and can help you remove some barriers too if you're comfortable with it, or if you're up against somebody that is removing those contingencies.
That's outstanding. Great stuff, Dietrich. So as we wrap things up, I mean, maybe why don't we talk about some pitfalls? Like, what things do you see out there when people aren't going through the proper process here?
Yeah, I mean, Aaron, I've, unfortunately seen quite a few ugly situations when people don't plan. But some of the biggest things is that, it ends up they don't get the house they want. If something comes up, and it happens literally happens to me almost every week. Every week, somebody comes and calls me and needs to get pre-approved quickly. A house came on the market in a neighborhood that they didn't expect it to happen, and we have to scramble. I get them prepared, and they can make the offer, but they're behind the eight ball because of the factors and the planning that we haven't been able to do. And so it might limit their options, and their odds of getting that house go way down. So that's the biggest piece that I see, is that there's just, it's amazing how many situations that we come across that can be prevented, or just help people get the house that they really want because they were prepared to act on it and be in a strong position. They might and save a lot of stress in the process. It can make it an enjoyable experience. And if one that they can spend time on getting deciding what they want to do to the house, and not worrying about how they're going to get the house. So that's a big piece of it, is what I see is one of the major pitfalls if the planning is not done in advance.
So I think what I heard you say is proper planning can make getting a mortgage an enjoyable process. Is that what you said?
Yeah, absolutely.
Heard it here first, folks.
As enjoyable as it can be. And
Well, I know the clients I refer to you would probably call it an enjoyable process. So
thank you.
All right. Well, as we wrap up, anything else that people should be aware of or be thinking about as they think about moving up?
Yeah, I mean, I would just say again, to summarize, as far as planning a few months to a year in advance, working with the loan officer, not just an institution, but an actual loan officer that they know and can trust, that can be with them every step of the way, and one that can advise them on all the options that are out there and available for their specific situation. Some companies can do things better than others. Some have limitations. Some have more flexibility. So it's just important to have that big picture and work with somebody that is able to be more of an advisor. And then I think it just sets up that move up to be smooth and successful, and when that right house comes along.
Outstanding. Well, Dietrich, thank you so much. I really appreciate your time and sharing your wealth of knowledge with us here. It's been great. Thank you so much for joining us for this episode of Behind the Scenes. We hope that you enjoyed it and got some value out of it. As always, we'd love to hear your feedback, so drop us a line, and please subscribe to our YouTube channel and follow us on all the social medias. We'd love to be connected with you. So thank you so much. We'll see you next time. Take care.
House goals realized. JanusGroup at RE/MAX Integrity.
It's a tooth!